Thank you for coming to this panel discussion today on discussions around ESG and climate actions in driving growth, and ultimately the conversations around the growth of carbon market in Africa. Today we want to have a conversation that first it's unfolding in terms of design, but at the same time, the conversation is unfolding in terms of the possibility and the questions about the reality in a continent that promises to be part of it, despite the enormous challenges on the continent. Now, the conversation for most people is very much around what role the private sector can play in driving this agenda. First, there's a global drive towards sustainable development, and we've seen the increased role for private sector to be part of that global drive because of the technology that they have, the capital base with them, the knowledge streams required, but ultimately they are also a group of people who can drive scale and action that we need, and Africa stands to be part of and to benefit from that. And this conversation is very much nested within the notion that whatever is good for the society is also good for business. And the private sector, businesses on the continent globally have got a role to play in achieving sustainable development on the ground, not just in the design, not just in the conversation, but more importantly in the action and the impact on the ground. And today, just in the interest of time, generally we want to talk about how some of the new global initiatives and norms that are quite fast emerging, such as environment, social and governance, ESG, net zero, and climate action, how are they, to what extent are they tools for achieving and driving investment flows to Africa? But more specifically, we also wanted to focus on the growth of the carbon market. I think it was also very good to hear part of the last conversation. And I think in this conversation, we want to look at it using a positive lens, but also we also want to be very, very honest with ourselves in terms of what do we need to do differently for this to make a meaningful contribution to sustainable development in Africa. And please keep that in mind. What do we need to do differently to make carbon market work for Africa? And this is a conversation that we are all going to be having today. First, the conversation between the panelists or among the panelists, and secondly, conversation with you. We want you to be part of it. So without much time, I want to invite my very able, brilliant panel of thinkers and doers who are going to be sharing from their wealth of experience in terms of what they are doing. Please welcome with me Michael Akampa, co-founder and chairman of Nobon, Adrian Mill, Lion Rouge, and ESS, Farai Sekeso of Pegasus Capital Advisors, and Head who is as well, nature-based lead at Respira. Great. So if I may join these guys here. So what we want to do, I think it's important for you to get a chance to know what they are doing and how that speaks to the conversation around driving growth. So gentlemen, and forgive us that this is very gender inclusive. And it's a football team, the male football team. But we are hoping that we will get some of our ladies to give questions, be part of this conversation. So Michael, I want to start with you. Please just reflect on your work and how some of these norms, ESG, net zero, climate action, whatever it is that speaks to your work, how is that driving growth and investment on the ground for you?
Thanks a lot, Olu. And I think the starting point for me is looking at, when we look at the last Global Risks Report, we see that there's been a very big shift in terms of risks towards environmental risks. And over the next 10, 20, 30-year horizon, all the top 4, top 5, top 6 environmental risks. We see that environmental, the E part of ESG is a big driver for growth in any business. I recently attended the insurance innovators, and all the insurance firms that are the biggest asset allocators were saying that before they looked at the financial, but if there is no environmental plan, there's basically no investment plan. So environmental is really a driver for growth of businesses, for growth of capital markets, and even for growth of economies. And when you look at addressing that, really the biggest need, there's a lot of gap to do what we need to do, and a lot of it will come from the private sector. So the private sector is a driver for the growth of, for the closing this gap, for scaling up different solutions. And on the other hand, it's not just that we're looking at the private sector to put in funds. The private sector is also the executor of last resort, if I may say, that can do it at speed, that can do it at scale, and particularly in a continent like Africa, where public society is public service is very, very stretched in terms of budget, in terms of capacity. We have to look at enabling the private sector to do its work or to collaborate with the public. And in our work, really what we try to do is to connect these two pieces, is to enable the flow of private capital. And private capital is extremely important in the context of Africa because our public markets are not developed, and they probably won't develop fast enough to help us address what we need to address. So what we do at Norborn is basically building an infrastructure into which private capital can flow into these very important initiatives. And carbon markets, we see it really as, however controversial it is, it comes closer to providing a mechanism for private capital to happen. So I think the question is on how do we address the very relevant concerns that are raised around it and have it help grow the different works that we need to do on both the environmental and social perspective.
Great, thank you. Adrian.
Yeah, look, I'm coming at this from two hats. I have a ESG advisory firm focused on creating the next generation of ESG leaders in Africa, but also from a project developer, a carbon and biodiversity project developer, as the managing director of Lion Rouge, which I co-founded with. It's a big project. Its flagship project is a massive safari park, basically, in Senegal, which is a safe country in West Africa and stable. As we've probably heard in the news, West Africa doesn't get top marks in terms of security, and sadly, the West African species are in what may indeed be terminal decline if a project of this scale doesn't get put in place. So we see, the possibility of carbon markets to protect these areas is obviously massive. That's what it's designed for. And obviously it requires people who understand ESG, it requires people who understand carbon, and everyone's going to be really shocked by this, but very few people do. It's really just starting out as a market and as a concept and as people developers. So often what we find is that people come to us and go, have you got experience doing this? It's like, well, find me someone with experience doing this, right? Like, it doesn't exist. It's very new. So we have to take risk to a degree. How do we de-risk it? Well, a project like ours has been quite unique because there is no Big Five safari park. Big Five is elephants, rhinos, lions, leopards, buffaloes. So we only have one elephant left in Senegal. All right, male, bull, very sad, okay? We've got 50 lions left in Senegal. West African species, different to the other ones. You and I would look at it and go, looks like a lion, but still it's slightly different. But it needs to be protected, and they are going down, sadly, despite significant intervention by NGOs. So I think we see, as part of the solution, bringing people in. So my co-founder, his father built a safari park in Senegal, right? This is really rare, right? So one of the only places in West Africa where we have this knowledge. He studied in South Africa conservation. Part of our team, we talked about gender balance. We've got, in my ESS company, the ESG company, 50% female. Similar sort of thing with Lion Rouge. And it's very much designed to be gender inclusive, climate smart, agriculture smart, community involvement. And I think that's the way we're going to have to develop projects in this area.
Right. All right.
Very good. So I'm with Pegasus, and we manage the Subnational Climate Fund, which is a blended finance initiative anchored by the GCF. And so for us, ESG and climate solutions are two sides of the same coin. ESG we look at as a way to mitigate and manage risk, because you need to make sure that all your environmental and social and governance safeguards are in place before you sort of do an investment. And then climate solutions are a way for us to achieve growth. How do we define growth? More investment, more megawatts deployed, jobs created, and the like. How do we drive this investment in the African context with relation to ESG? And this is, firstly, we realize there's a dearth of expertise in taking projects to a point where they're bankable. Yeah, so climate solutions, projects that are lacking ESG type mitigants put in place. And so we deploy our team that's able to work in projects much earlier, to help entrepreneurs and developers with their projects that have the right building blocks but haven't been put together in a way that you can make it bankable. That's the first thing we do. Second thing we do is we've got our technical assistance facility, which is sort of adjacent to the fund. And there we also deploy it to prepare projects, to do the ESIAs, do the ESMPs, to get their environmental and social standards up to scratch for us to be able to do the investment. And then finally, we deploy our expertise as investment professionals to grow businesses, allow them to then access debt capital. I think the last panel talked about accessing debt capital. We provide equity as an equity investment vehicle, but we also then take an active role in managing these businesses, helping the entrepreneurs to grow the business and get it to a point where we can attract external third-party capital. So that's how we're driving it. So ultimately, ESG for us is a risk mitigation thing, but also a manner in which we're driving. If ESG is not present in the investments we're looking at, we are trying to make sure that it is there. We're using it as the core of what we do. We can't separate ESG from climate solutions. And I hope that ultimately ESG is not an exception to access capital, but a way we're doing business in Africa, ultimately. And then that sort of leads on naturally to the carbon market space, right? We do look at projects with carbon credit. We don't look at it as the core, but as an add-on. But there are attendant risks there, right, that we still need to think about in the African context around additionality, around shared benefit. How does that affect the business? It goes back to your ESG and how you're managing that risk, right? So I think to wrap up just on this initial question, the drive of investment for us really is ESG being at the forefront, mitigating risk, making sure that we are a responsible investor, a good steward of the money that we invest on behalf of the GCF and our other private investors in the fund, but also making sure that we're pushing that growth, and that is through making sure we're creating employment for people, direct and indirect, and that's how we're sort of doing it within the Pegasus context and Subnational Climate Fund. Thanks.
Great, thank you. Ed?
Well, I lead nature-based solutions at Respiro, which is a carbon finance organization. So we back what we believe to be the best carbon projects globally. We've made 13 investments to date. 7 of those have been in Africa. So I think that tells you something. We have a global mandate, but we've found some really great projects and investments in Africa. A couple of things to reflect on this conversation. I think that carbon markets are the thing which have really enabled private capital to be unlocked into, certainly in the space that I work in nature-based solutions. I come from a conservation background. I spent many years working for an international conservation organization. I was based in Nairobi and led their forest program there, and we're always looking at bankable models to get private capital to flow into nature-based solutions. And carbon, the emergence of carbon credits and carbon markets has really been key to unlocking that private capital. Just a few years ago, there's no way that we I work for Respiro, it's an investment manager. We manage private capital, and there's no way that I'd be able to talk to a conservation project developer without that source of revenue underpinning it, and it's completely changed that conversation. Now, of course, the market does have challenges, and we can get into those, but I think that it's the first environmental ecosystem service that has really got a value now placed upon it, and that's something that we can build upon. From an ESG perspective, it was alluded to earlier that just because you issue a carbon credit doesn't necessarily mean that it's good from an ESG perspective. So that's an increasing area of focus for us. We've just done a partnership with Palladium Group to be the ESG advisors to us. We're seeing increasing focus from development banks and other financiers who want really rigorous ESG principles in addition to just verified carbon credits.
Great, thank you. So, and I imagine some of you in the audience, you started developing questions, and perhaps you also want to make some contribution, and I'm hoping we're going to get to that. So, gentlemen, you've alluded to a few points. So, number one, ESG, climate actions, two sides of the same coin. And it shouldn't just be about accessing capital. It should be about changing the way we do things. And ultimately, that allocates agency to private sector. We're part of the broader team of people that need to, that are needed to achieve sustainable development on the ground. And again, ESG is a way of mitigating risk. There's some inherent risk within the ecosystem, and by approaching an ESG model or an ESG framework, you have an opportunity to mitigate that. Now, I want us to shift to specifically, and some of you have touched on the point on carbon market in particular. From where I stand, I work for a development finance institution, so we work with a lot of you in providing that capital, and ultimately you can deploy them to where projects are. We find ourselves in the second wave of the global carbon economy. In the first wave, the Kyoto wave, Africa missed out relatively. There were few CDM projects in just very few countries, despite the enormous opportunity for projects on the continent. For some reasons, Africa was not part of it. Now we've moved to the Paris era. We're now in the second wave. And in fact, there are conversations around having a sophisticated approach to carbon markets. So you can have a voluntary carbon market, you can have an Article 6 engagement, government to government within ITMOs. You can also have a compliance market. We're beginning to see developing countries that are even having compliance markets. I want us to situate Africa more from the opportunity side in this conversation. And Ed, I want to start with you because you focus on nature-based solutions, and the opportunities in Africa are just enormous. What do you think, as an organization, you would like to see for us to be able to scale carbon projects on the ground? What do we need to see on the ground? Not just from the private sector community, but also from the public sector and for other stakeholders as well.
Well, I think we need to see three things. We need clarity and integrity on the supply side. We need clear demand signals, and we need stable policy. Now, just to unpick a little bit of those into some more detail. On the supply side, we desperately need to unify about which specific methodologies are deemed good enough. There's a industry initiative underway at the moment called the Integrity Council on Voluntary Carbon Markets. They're very soon going to make their decisions as to which specific methodologies get what's called the core carbon principle status, which is essentially a tag of they've reviewed all of the methodologies out there and they have deemed which ones they feel are good enough to meet the integrity standards that the industry needs. But specifically from a DD perspective, what that means is carbon integrity, making sure that 1 ton is a ton. Community integrity, making sure that the community is involved in projects are getting a fair share. And biodiversity integrity for the nature-based projects, making sure that these are projects which are net benefits to biodiversity and not just resulting in huge monocultures. That's not the vision of what we're trying to achieve here. On the supply on the demand side, needs real clarity from some of the international bodies as to what you can use a carbon credit for. There's a number of initiatives such as the SBTi, Science-Based Targets initiative, who are reviewing their guidance at the moment for what you can use and what you can claim a carbon credit for. That is absolutely crucial for firming up that demand signals. But as alluded to there's a number of initiatives on the compliance side of things and on Article 6. We need clarity as soon as possible about which credits are eligible under Article 6 mechanisms and how that system is actually going to work. On the compliance mechanisms, again, there are regional and even national compliance markets emerging all over the place. So, for example, in Africa, South Africa has a compliance market, which means that a certain percentage of the taxes, there's a carbon tax in South Africa, and a certain percentage of that can be paid through buying carbon credits instead of the tax. So that's the kind of example of a already sophisticated and developed compliance market in Africa, which is already up and running. And from a regulatory perspective, that policy certainty is really key for investors. Not knowing if the government knows about the projects, that's not good for us. Not knowing what the tax rate is going to be, that's not good for us. Not knowing if what's known as a corresponding adjustment is going to be given or not, that's not good for us. So as soon as those three things can really come together, then this market can go from something which is a few $100 million of income for Africa at the moment into the billions. And that's what we want to see as soon as possible.
Great. Ed, I'm going to come back to you later, but I want you to reflect on the question. You mentioned policy. What kind of policy shift do we need to put in place? Or what do you don't have to answer now. We're going to come back later.
Okay.
I'm hoping we're going to have time for that. But what kind of, because it's easy to just say policy, we need a policy environment. What specific policy shift must be in place for this to happen? Farai, so when we hear the numbers, we're talking of a global carbon market that now runs into trillions if you aggregate the compliance.
That's right.
And other markets. And Africa is not anywhere, it's just barely 2% of that. Mm-hmm. What do we need to do to increase the margin? If we're going to move from 2% to, say, 5% in the next 5 years, I want us to be very specific. What do you think we should do?
Look, I think you just touched on the things we need to address, but when I look at it from a financial point of view and I look at it, how we look at carbon credits and why they're not as big as they should be, is I think the 2 points I touched on, which is firstly the additionality of the credits that we are creating. Are they really offsetting the carbon as we say they are? And I think that goes to the carbon standards that are being developed, right? Because I think the value of a credit is exactly how much offset you get to it. And if we're not clear on the additionality of the credits we're generating in Africa, I think the market is not going to develop. The second thing, again, like I've said, is benefits sharing with the community. It goes back to your ESG. Yeah. A lot of in my experience, a lot of the carbon projects I've looked at, have funded some in the past, do not have a community benefit, or the community is not sharing in them, or the individuals on the continent who are using the equipment, be it the cook stoves or anything else, are not getting the benefit apart from a stove that they're just given and they can use over a period. And I think if there is clear accountability on sharing part of that benefit, and with the drive of ESG amongst international investors and wanting to make a real difference. So this now goes to making a real difference, a real impact, beyond just sort of saying we're buying the carbon credits. If the people that are generating these credits are also benefiting, I think you can also start claiming a premium on, some of these credits. So I think those are, when I look at just from a financing point of view. I think thirdly and finally, probably on a smaller scale, is we need to start thinking about how can we use carbon credits to unlock financing for the businesses. I think the previous panel talked about accessing debt on the back of carbon credits. We're looking at opportunities now where we're saying, okay, this is the equity we're giving, how much carbon credits can be generated and can be sold in advance, and creating a market where you can give your credits for sale for the next 5 years, 7 years as you're generating them. I think that is a way to not only grow the carbon market, but channel more capital upfront that is required to grow and implement some of these projects that then generate carbon credits. But then I think ultimately, without repeating what's been said, it's about policy, it's about the regulation. But I think more importantly, it's making sure that we are making sure that the additionality is right. Correct. And it's very transparent, and that we are sharing those benefits, and that we are being responsible with the credits that we're claiming, and making money off and make sure that those benefits are shared. I think that's how you grow it.
Great, thank you, Farai. So everything you've described is what we would generally call integrity, high quality.
Absolutely.
Now, I'm going to put you on the spot here, Andrew. What is high quality? What is high integrity?
Yeah, it's actually fairly straightforward. I mean, basically, if you were to go to any national park and you went in there and you saw it looks like a nice, thriving biodiversity, lots of animals, lots of beautiful green plants, depending on the season, then you're pretty sure that it's, it's got good high integrity, right? If there's lots of trees and so forth, good high integrity. Obviously, that bundling of communities is critical, but I might even just, if you don't mind, hijack a little bit this. And I can't believe it takes the ESG guy to tell everyone this, right? But the carbon credits, it's great to make money off them, but actually it should be looked at more like a startup capital for a business. A profitable business, right? You have to make money. If it's not making money, what are we doing? Yeah, the communities have to benefit, absolutely. It has to be really good from a biodiversity, high integrity, absolutely. But if it hasn't got a business underpinning, a business model underpinning it, making money, how do you lock in the permanence? Permanence is the critical thing. If you can't demonstrate that over 100 years it's there, then there's no point in having the conversation. Like, close the case, next project, please, right? Which is why our business model in Leon Rouge, focusing on the permanence, focusing on a business plan, focusing on community benefits. I often say to people, and they don't like this, and again, I'm the ESG guy, right? Like, I'm out there making sure risk and compliance is managed. And as a project developer, I'm out there making the highest quality credits we can, with a view for biodiversity credits and a view for a profitable business. But carbon is an element. Carbon is like mining. I take gold from the ground and I put it into a gold bar. I transfer the element to another place and another use. I take carbon from the sky, I put it in the ground and in the trees, in the biodiversity, right? It's mining. Now, no one wants to say this. It's bizarre for me because we work a lot with miners. A lot of people are like, oh, mining's very bad. Mining's great if it's done well. It's like anything. There's lots of, like Coca-Cola is great for drinking, but it's also very bad from an environmental perspective, right? Like, there's lots of good things and bad. It has to be managed appropriately. So, not just Coca-Cola, there's lots of other drinks, right? But the point being, as a mining conceptual thing, if you go to a mining company, they share their benefits. Now, some of them, it's very small, right? And of course, they need a business plan. They need to make money, right? The beautiful thing about our mining is that we have zero exploration capital cost. We know exactly where the carbon is, right above us, all around us, right? Super straightforward. I've just gotten rid of $5 to $10 million worth of exploration capital right there. People should be pouring into this. It's unbelievable. Like, the opportunity is mad. And then the carbon credit markets obviously need to respond to that because that's where the money lies. That's where the possibility lies. And carbon is obviously not just parks. It can also be when we displace the use of fossil fuels with energy, renewable energies and so forth. But I don't know if you've been to a solar park. Not exactly crowded with biodiversity, right? Like, the first thing they do is sweep the area clean, chuck down some gravel, plonk up some panels, right? Fantastic. I'm developing other projects in other countries where we have dual use. You put it on top of greenhouses, or you let the sheep come underneath and you let things grow. So there's ways to do things where you integrate these concepts. So when I say business plan, I'm not just talking about parks. I can be talking about anything which can integrate it, and it could be integrated alongside an actual project, mining, agriculture, etc. They can all do a carbon project. Whether or not they profit from that or they use it as the thing, say, look at all this good we're doing alongside our project, that's another question.
Adrian, good point. Thank you very much. Now, I like to think of the carbon market as a behavior market. Now, you commit to being a good person for 30, 40 years, 20 years, depending. Now, I want you to ask yourself, can you really be a good man for 20 years?
Well, as we say in Senegal, inshallah. I mean, I'm very, very keen. As an ESG person, it's my passion, right? But I think who amongst us doesn't want to leave something better for their kids? Like, you'd have to be evil not to want that to happen.
But
so I think that's
look
great.
at the market as an incentive framework to keep you within a particular way of behavior.
For sure.
Is that possible for that period of time?
I think money talks. Like, if you're getting money for what you do, you have a huge incentive to do it. But let's be very clear, carbon market has had issues in Australia, other places where they've said all kinds of things, and that's why we need all the things that have been described previously in terms of the frameworks around to ensure the true carbon capture.
Thank you. Thank you very much. I also imagine you're going to have a lot of questions, so we're going to get to you very soon. I'm going to come to you. You've heard these guys from the integrity part of it to the side of the business model, but also the profitability in there and why we should be doing it on the continent. I want you to reflect on the market shift side. So it's not just the policy that needs to make certain shifts or provide an enabling environment. We also need to look at the market for it, both on the demand side and on the supply side. What has been your experience when it comes to market for carbon credits?
I think I'll start from one point that Adrian raised, and that has been echoed across the panel, which is the communities benefiting or sharing from the project. I read a report from the CIF Alliance that I believe all of you have read that say that 60 to 90% of the value of carbon credit transactions in Africa do not, they leak. They don't get to local communities.
Okay.
So a mere 10 to 40% is what communities get. And we've read different articles in the press that put it at the lower tail of 10%. And when you look at climate action, where does it really happen? And in a continent like Africa, where like the biggest interventions, the biggest potential is in nature-based solution, is in conservation, you see that the communities are at the center of this whole. The communities sit at supply. They're the ones that do the activities. They're the ones that do behavior change. And money is a good way to, livelihood is a good way to motivate behavior change over generations. But it also has to be shaped and guided by policy. So if it is truly, I think the biodiversity that is in Africa, that's one of the richest globally, benefits us as a global economy. And the policy framework should both support it, from global conventions all the way to local laws. So if the communities can genuinely benefit, if they can move to the higher end of the transaction, and their livelihoods depend on it, and it's set in policies that enable that to happen across generation, then we can see sustainability. And really, supply is all anchored in: are you able to organize communities, to aggregate communities, to develop really good projects? All good projects start and end with the communities involved. And so that's really one part, and I think that's what we need to scale. I've been at two forums just about 2 weeks ago at the Africa Berlin Forum, and it was talking a lot about conservation, and that conservation needs to shift from protecting animals and protected areas to enabling communities to be able to find better ways to coexist with this ecosystem. But I think the point that I'm getting to is that there's a lack of capacity in terms of developing good projects. There is a lack of capital to be able to, take projects through development. It takes years to do a good project. It takes like millions of dollars to be able to do it. And to invest, and de-risk this to happen at scale, there has to be very clear signals from demand. So who is buying? And how public is this knowledge? Do we know who's buying? Do we know what the criteria is? Do we know? So even the demand side is still abstract. And I think we need to work more and to open it up so that it's a lot clearer. It sends a lot clearer messages that enables the markets to take off.
Thank you very much. We've got a few minutes left, and we want to move to the other side of the conversation, and that is from you. Any question, any reflection, any idea, thought, or any disagreement? Good. We can take 2 or 3. Yes,
Thank
please.
you. Yeah, Shaz from Admeus Capital Partners, headquartered in Rwanda. Thank you so much for an amazing panel. I was really agreeing so much, Michael, with what you said about this needs to be about going back to the community and basically democratizing carbon credits or decentralizing carbon credits. So I wondered if any of the panel had any understanding of which approaches are working best to be able to do that. Is it biodiversity? Is it soil sequestration? What's actually happening on the ground? I think we know about Acorn, Rabobank. There's plenty of examples in India, but what's actually working as at now?
Great. Good question. What is working? I'm going to come to that. Let's see if we can just take 1 or 2 more. Krishna.
So my question is, and I've heard a lot about the risk management and then the kind of the enabler and the revenue, but we're still having them as separate conversations. And even if we talk about policy will either address environment or will address community development. How do we bring an integrative approach so that it's all integrated into our business model? Because I think there's value here that can be derived, and we're kind of looking at it as either risk or an enabler. But how do we drive an integrative model that is not just looked at from the business side, but here I'm asking the question from a business side, but then also drives a more integrated policy look at as well?
Thank you. Brilliant question. Integrated model. Great. I saw a hand here. Yes.
Thanks. I'm Charles Buchanan from EY, Sustainable Finance. And I'm working on a number of carbon credit programs, getting projects developed. And something that I'm personally obsessed with is trying to figure out how we can leverage off pre-purchases, because I think that that's probably the commercial or the financial tool that is going to help to unlock a lot of these. It can offset some of that long-term risk, but it can also unlock sufficient funding up front to help to fund some of the project development costs. And if it's used wisely, then it can do exactly what you said, Adrian. It can help to unlock those commercial opportunities. Because what I've found is I've got fantastic commercial opportunities, but they're going into a system or part of the economy that isn't developed and can't support their growth for, say, 2 to 3 years or 5 years. So they need time to be able to grow and then really take advantage of the opportunity that they have before them. Thanks.
Great question. Pre-purchases, and that could really be a game changer on the ground. But also questions about democratizing, projects on the ground. We're looking at not just carbon, but look at communities beyond carbon, but also integrated model. Any taker, please? 1 minute each.
I can go first.
1 minute.
I think the first one is aggregating communities. So there has to be an aggregator. They have to be organized and aggregated into larger groups. And then the second is about which initiatives. I think anything that can improve soils, because all our livelihoods really depend on good soils, and it's a whole range of interventions. And talking about an integrated approach, on the urban infrastructure, we enable basically projects to be able to do both project finance and carbon credit financing, and enable off-takers to be able to structure a pre-finance agreement that then, basically you don't just raise carbon finance. You raise both project finance and and carbon finance all in one within the same infrastructure, and you can have off-takers for either the produce that you're going to make and the carbon credits that you're going to generate, and enabling more of these instruments to interact with supply quite early and layering on de-risking instruments like the guarantee that we've been working on with CEDA is one way to drive and take away as much risk and enable it to scale.
Great.
Yeah, on a few topics there, but with regards to the communities, as a future Senegalese, I can't speak for all Africans. I've been in 14 years, but I can tell you, as someone who's waiting for the president to sign my citizenship, that you shouldn't be telling Africans what to do. No one should be coming in there, even as a project developer, saying this is what you want. They know what they want. If I bring a park there, there's not 1,000 billion jobs. It's like 100 jobs, right? And those who want to be part of that will be part of that. You know what we do is we say, we'll give you the money from the carbon credits. And again, we can't say that we're going to give them 100% of the money because you need to run a park. You have to get the park. They're going to make money from the land acquisition and other things like this. But they'll also, and most importantly, our model is to put money in their pockets on a monthly basis, hopefully to the woman of the family, so it gets spent on things like education and health and so forth, stuff like this. That's how communities want to do. They want to spend their own money, and if it can be, a good chunk of like a 20% of their monthly average amount, that's what they want, right? That's great. If I came to you and said, "Do you want a 20% salary pay rise?" You'd be like, "Yes, please," right? They want that too. And then when we're talking about the policy side of things, I know that we're talking about integrated approach. There's only so much we can integrate. I mean, already we're talking about 20 or 30 disciplines that have to be managed under ESG. And a carbon credit project adds in the economic aspect as well. Frankly, we try and do things as an integrated way possible, but every actor has its own roles to play, and there's nothing wrong with that. Having multiple actors is part of the whole dance, right? So I think those two were really the critical ones. The pre-sale one is what is basically the big elephant in the room, right? If I am to say elephants, given that we're going to have some. But we need this money, and talk to them. This is where that conversation comes of pre-sales. We can find the off-takers desperately looking for these credits. So as long as we can show there's a business model and you're making money, it's business making money, then the money comes from a pre-sale.
Business making money.
Yeah.
I'll go on. 30 seconds.
30 seconds. Well,
yes.
I'll simply say, I think on the integrated approach, I think it's behavioral. I think it goes to trying to foster a behavior and way of thinking that looks at all of these aspects together, not in silos. On the pre-financing, I think it's a very innovative way to raise capital. I think the idea should be, do you want all the capital upfront now, or are you pre-selling and receiving predetermined cash every year? I think what's better is capital now, but you're going to have to do it at a discount. So you need to sit and think about it with your client, I guess, or the investors in the business, and think about what's best. Is it cash upfront to make the development better now, or do you want the cash as we go? So it's about how much cash you need now versus how much you need consistently, anchored by a business model that's profitable. That's how we look at it. With you.
Quickly, prepay live example. Our first fund was an off-take vehicle payment on delivery. Mm-hmm. Most of the upfront costs were borne either through grants or committed conservationists putting their life savings into it, and then we could buy the carbon credits, warehouse them, sell them, profit share if there's a price rise. Now we're moving to prepay for the next generation of projects, needs more upfront capital, moving the sector away from grants towards private capital. Very quickly, 90% of projects to date in Africa have come from renewable energy, RED Plus or cook stoves. Big updates going on to all of those methodologies, issues with all of them, likely to evolve towards nature-based removals in the future, reforestation projects. There are a number of soil carbon projects in the works, but essentially there's a shift kind of going on from avoidance tons towards removal tons, but we shouldn't forget avoidance tons in the meantime, but the methodologies do need to be updated.
Great. So in the interest of time, I wouldn't even try to summarize, but I want to just specially thank all of you. Let me say this is the beginning of a long conversation. It's not going to be easier. It's going to get tougher along the way, but it's very doable. And I think Africa must be part of the global conversation and the global actions around the opportunities that exist in the carbon market. And we encourage all of you to look out for new partnership, new ideas, and new ways of working together. And thank you very much to this panel. Please put your hands together to appreciate this brilliant panel.